For the longest time, it's felt like there are these two totally separate financial universes. On one hand, you've got the old world of Wall Street, right? Built on institutions, stability, tradition. And on the other, you have the new world of crypto, built on code and decentralization. But here's the thing, that's all changing. A huge financial rotation is happening as these two worlds are finally starting to collide. So let's break down what's really going on. Remember that last big crypto crash? I mean, pretty much everyone was writing its obituary. People thought, that's it, it's over. But that's not what happened at all. It just got quiet. And let me tell you, in finance, silence is often where the really smart money makes its moves, way, way far away from all the noise. So, to really wrap our heads around this shift, you have to understand the two very different systems at play here. One is built on literally centuries of tradition, and the other? It's built on about a decade of seriously disruptive code. They could not be more different. And this slide just shows that contrast perfectly. Over on the left, you've got the Bank for International Settlements. Their whole mission is promoting global monetary and financial stability. It's slow, it's deliberate, it's very top-down. And then, look at the right. That's the Bitcoin blockchain. It's alive, chaotic, 24/7 feed of transactions happening in real time. It is the very definition of a bottom-up system. For years, there was this massive wall separating these two worlds, a wall built out of regulations, risk, and just a whole lot of misunderstanding. But that wall, it's starting to crumble. Bridges are being built. And they're being built by some of the biggest names in the entire game. And these bridges are being built right out in the open. I mean, this is a snapshot from Fidelity, one of the largest brokerages on the planet. And look, right there, nestled between mutual funds and ETFs, you see it. Crypto. This is not a fringe asset anymore. It's being offered to millions of everyday investors, right alongside their retirement accounts. And it's not just for retail investors. This is the big one. When BlackRock, the world's largest asset manager, enters the scene, you know a fundamental shift is happening. They aren't just dipping their toes in the water, they're creating dedicated digital asset funds. This is the ultimate green light for institutional capital. But look, for big money to invest with any kind of confidence, it can't rely on hype or tweets. It needs data, and that's where companies like CryptoQuant come into the picture. They provide what's called on-chain analytics, which is really just a fancy way of saying they churn the blockchain's raw public data into charts and signals that professional traders can actually use. The Pro Toolkit is officially here. So all of this brings us to the real heart of our story. With the bridges built and the professional tools in place, we can now actually see how money moves between these two universes. And a recent market crash gives us the perfect case study for following the money. It's the question everybody asks when the markets turn red, right? Bitcoin dropped, altcoins got crushed, but that money doesn't just vanish into thin air. It rotates, it moves somewhere else. The big question is, where did it go? The answer is actually one of the oldest plays in the financial book. The money fled the high-risk, high-reward world of crypto and moved into the perceived safety of gold. Now, this is a really key point. This wasn't a failure of crypto. It was a classic defensive move, and it shows us that institutional investors are now treating crypto just like any other risk asset. And why gold specifically? Well, it's because gold loves uncertainty. With interest rates rising, geopolitical tensions flaring up, and a lot of fear about traditional currencies losing their value, gold became the ultimate safe harbor. It's the place capital goes to hide out from the storm. Now this is where we see the real difference between the smart money and the crowd. While a lot of retail investors were panic selling, the data shows that institutional players were strategically buying Bitcoin in a really specific price range, between $70,000 and $80,000. This wasn't random buying. This was a calculated move to establish a new support level, a new floor for the market. So we've seen how the big players are making their moves. Now let's just zoom out for a second and really appreciate the sheer scale of the asset class they're moving into. And to talk about size, we just need to know one key term: market cap. It's super simple. It's just the total value of all the coins out there. Think of it like the total price tag for the entire cryptocurrency network. Now just look at these numbers for a second. Bitcoin's market cap is over $1.3 trillion. That's trillion with a T. Ethereum is in the hundreds of billions. We are talking about an asset class with a total value in the trillions. This isn't some niche market anymore. This is a global economic force. And even within this massive market, one asset is still king. This chart shows that Bitcoin alone makes up over half of the entire crypto market's value. It's the anchor. It's the reserve asset of this new digital world. When the big institutions think crypto, they almost always start with Bitcoin. Okay, so we've seen capital rotate from crypto into the safety of gold. We've seen institutions build a new floor for Bitcoin. So the question is, what happens next? What we have to look for is the next rotation. Well, once the economic storm starts to calm down, that capital sitting safely in gold starts looking for growth again. And that's when Bitcoin starts to look like a very compelling destination. I mean, think about it. It has a fixed supply, unlike gold, which can always be mined. You can move it anywhere in the world instantly, and its potential for growth is just on another level compared to gold. And, as we've seen, it's gaining that institutional legitimacy every single day. You know, it's one of the simplest but most powerful rules in any market. Before the money moves, attention moves first. Capital flows to where the story is, to where the interest is building. Price follows attention. And that brings us to our final thought here. For the very first time, the full attention of traditional finance, we're talking about the largest pool of capital in the world, is turning towards this new digital asset class. The bridges are built, the tools are ready, and the great rotation has already begun. So the real question is, what happens when all of that attention turns into action?